Hi, and welcome to the Stockscores Market Minutes for May 21st, 2018. This week's topic, focus on the trade, not the money. Most trading mistakes are the result of emotion. The emotion is aroused by the emotional attachment that most of us have to money. Fear and greed are your enemies in trading. You will trade better if you take all the focus off of the money and instead focus on the merits of the trade. Is it fitting your rules? Is there evidence from the trading activity that it is likely to move in the direction you expect? Or are you trading it because of the fear that it might go up and you won't be in the trade? Or are you avoiding selling because your greed says, well, it could go higher? You can't trust your emotions. You can only trust the message of the market. All right, let's get into this week's analysis. And this week was a sort of a compression week. What do I mean by that? The volatility in the market was compressing. This is the 30-day, 60-minute chart. And you can see that we had a pretty good run. We came up to the downward trend line on the daily chart and broke it last week. And then we sort of have been going sideways at that trend line, with each wave up and down has been getting tighter and tighter. What that means is that the market is building a base, gaining confidence that it will then break from either up or down. I think it's more likely to be up than down because we did break the downward trend line. But until we break out of this pattern, and this is called a pennant pattern, you can draw it like this too, until we break one way or the other, I don't think you can really predict it. And so watch for the break to tell you what the next leg of the market move is going to be. Now here we look at the weekly chart, and of course we've got that long-term upward trend line that we've drawn on here many times. There is the shorter term downward trend line that basically captures the correction that we had since the middle of January. And there's what I talked about where we've had the break of that downward trend line. And that's why I think we're more likely to go lower than higher. We're just building a base to launch off of in the near term. It doesn't guarantee that we will launch to the upside. We could break down and go back into the downward sloping correction phase, but most likely we move up. And so watch for that break on the shorter term chart to tell you what's happening. This is an encouraging chart if you are a bull, because the Russell 2000 has been able to break out to new highs. And of course, it has lagged the large cap stocks for a long time, and it's now leading. Unlike the large caps, the S&P 500, the small caps are breaking to new highs. Now, they're still way behind in terms of performance, but this is an encouraging sign, especially if you trade with less capital, where you like to trade those lower price stocks because they don't take as much capital. They tend to be more volatile. And I am seeing a pickup in the action in those stocks, the biotech sector being one, where you're seeing some improving market action after a fairly long period of rest. Moving on to the Canadian market, you can see that we've kind of in this upward trend for some time. Again, this is the short-term chart. This is driven mostly by the movement in oil. Strength in oil heavily influence on the Canadian market, and of course with the strength in oil, the Canadian market has moved up in general, and this is encouraging. We had a little bit of a stall last week, and we're probably a little overbought. I think we could see it pull back near term without breaking the health of the Canadian market, but it feels like that is likely to happen near term, that pullback. And you see why when you look at the longer term chart. This is the weekly chart now. You can see that we're rising up into this resistance zone. We have some rising bottoms, so that's encouraging. But one more strong week, and we're going to hit that resistance level. And that's why I think we maybe punch a little higher and then back off and go sideways for a while, or maybe even pull back in the near term. We've had a pretty good gain in the Canadian market, and it's due for some profit taking. Where we don't have good gains is in the Canadian speculative market, but it has broken the downward trend line, and it has built a rising bottom. A lot of this is the cannabis stocks, which started to turn around last week, and I think could get some follow through to the upside in the near term. Their charts are looking better. They're actually looking quite similar to this chart, where they've made a considerable pullback, they've built a rising bottom, and now they're breaking to the upside. So if you like to trade those junior stocks, take a look at that cannabis sector, because it does look like it may start to lead again. Onto the Treasury bond market, which of course tells us where interest rates are going. Tried to break down through support this week. During the week, we were below that support price, but we managed to claw back and close above it. But I still think that there's a fairly substantial risk that this chart breaks down, which means interest rates go up, getting up over that 3% yield on the US Treasuries. And that could be, somewhat negative for industries where interest rates are important. So you need to be aware of that if you're investing in something like utilities, for example. The housing market, of course, sensitive to interest rate rises. So this is an important chart to watch if you trade those stocks, or if you're looking to get a mortgage yourself, because of course mortgage rates will rise. Onto the US dollar, which we've talked about quite a bit in the last little while because it broke that downward trend line. It's rallied quite nicely, and it's now at resistance, and so I expect it to stall there and maybe pull back and make the right shoulder of a head and shoulders bottom pattern. So my expectation is we see the US dollar stall in the next week or two, pull back a little bit, maybe even for a few weeks pull back, make that rising bottom shoulder, if you will, on the right side, and then try to break through that resistance, as it does look like the US dollar is breaking that long-term downward trend. And that has an influence on gold. Gold has been weak because the US dollar has been strong, and it's debatable whether we've broken that trend line. We're certainly right at it, and gold probably will bounce up, especially if the US dollar goes down near term on some profit taking. But the gold chart really doesn't look all that healthy because we can't seem to get through that resistance level. So until it does, I would shy away from these stocks unless there's some very specific story that is a positive one on the alpha side. The general trend of gold stocks is not going to be great until we can get a breakout. Can't say that for oil stocks. They continue to move higher. We are in this upward trend. Now, there's a pattern here that many people don't always see, and that's something called a rising wedge. And if I draw a line across there and a line across there, you can see that the bottoms are rising quicker than the tops are rising. And what that means is that the buyers are losing their enthusiasm. They're strong and they pull back. They're strong and they pull back. And this time they're not as strong as they were the previous time. And this time they're not as strong as they were the previous time. And the result is that you have this pattern called a rising wedge, which is a signal that the buyers are losing their enthusiasm. And that may be why the oil market tops out near term on some profit taking. Doesn't mean the end of the trend, but we could pull back to the trend line and still be healthy. But that would also be a reason for the Canadian market to get stuck at resistance. You can start to see how all of these charts are interconnected, and it's quite interesting when you start to think about those things. The VXX chart, which of course is the fear index, as it's often referred to, it really reflects the premium on futures of the S&P 500 short-term futures. And so when this is going up, it's because people are paying more for those futures, and that is an expectation that volatility is going to increase in the future. And what we've had the last couple of months is declining volatility, which means that insurance trade, where you're trying to protect yourself against downside in the market, is not as important. People aren't paying as much for it. We're still off of very elevated levels, or very low levels rather. We're still quite high off of those, but we've come down a long way also. So it feels like the market's gaining more confidence, the fear is going away, and that means this should continue lower. So my ratings then, bullish on both time frames for the US stock market, Canadian stocks neutral long term, because we are rallying into that resistance level where I expect we'll get stuck. I've left it at bullish short term because the trend is still up, and until the short term trend is broken, I'm going to remain bullish. Gold, neutral long term, bearish short term. It's had a fairly good pullback the last week or two. Oil, bullish on both time frames. Volatility is compressing on US stocks as the S&P struggles to break that downward trend line. Now I expect we will get a break from this low volatility soon, and it will most likely be to the upside. Canadian stocks have been rallying for some time, and they are rallying into resistance where they should stall after a great performance over the last month or so. Oil stocks are due for a pullback, and I think that could be the catalyst for some profit taking in the Canadian market. All right, let's do the trade of the week. This is I call this my worm trade. It looks for a Stockscores action candle on the 2-minute chart. This little gray dot right there is the action candle. But usually I show these trades on the long side where you're buying. In this case with Tesla, it was a short trade. Exactly the same principle as my long version. You just flip all the rules upside down. And on Tesla on Friday, had a pretty substantial sell-off, moving as much as 8.5 RR and finishing the day at 6 RR. That means if you risked $100 on the trade, you made $600. If you risked $500 on the trade, then you made $3,000. That's not your position size, that's your risk amount. And to calculate position size, we take the difference between the entry price and the support price or the stop loss price and divide that dollar amount into our risk tolerance. Let's say that's $100, and that's how we can arrive at our position size. And of course, you can leverage these things 3 to 1. So those are some of the economic things that I will be discussing in a free webinar that's coming up on the 29th of May on my day trading approach to the market. I'll talk about the economics of day trading, how much capital it takes, what kind of returns you can think about in terms of these different strategies that I trade every day. And then 2 days later on Thursday, May 31st, I will be doing a similar webinar, but focused on investing. For those of you that don't like the long or the short-term trading, you want to do more long-term managing of your portfolio, that sort of thing, I'll take those same concepts and apply them to longer-term charts, and we'll use the tools of Stockscores to identify or see how to identify trading opportunities. So both of those webinars are free. If you go to the Stockscores website, go to the upcoming events area on stockscores.com, you'll see those 2 webinars listed there. You can register for those. As I said, they're no cost, and I think they're quite educational, so hopefully you'll find them valuable. I hope that you like this video. If so, click on that subscribe button, click on the like button, tell your friends, tell anyone to listen. Most importantly, have a great week in the market and trade well.